Hello, everyone, and welcome back or welcome for your first time to an episode with the Dairy Signal. We're glad you could join. With us today, we have a great friend, great resource for you as we dive into all things that's happening in the markets and the vast variety. It's no shortage here. We have Ben Buckner with Ag Resource Company. So again, a great friend. Great to have you back for our kind of like our bi-weekly check-in, and there's never a shortage on your end. But before I hand it over to you to just delve into all things that are happening, I want to give a special shout out and thank you to our national sponsors who make not only the Dairy Signal, but also all of our programs that we put on throughout the calendar year possible. So thank you guys. Thank you for being aligned with PDPW, but in truth, you're truly standing hand in hand and alongside our fellow dairymen across the country. So thank you. Thank you for being part of it and sticking in with it through the long haul. Also, another thank you to our event sponsor, who's also a national sponsor, Dairy Management Inc., or DMI, our national checkoff. So thank you guys for tuning in and again, aligning with the Dairy Signal. Without further ado, and the true reason I want to cut to it, because I know there's never enough time. I know Ben's like always catching up for breath at the end. So I'm going to hand it over to Ben, because like I said, never shortage of content or things that are happening in the market space.
Thank you so much, Cassie. Always a pleasure. And we throw a lot at you every 2 weeks. So we'll just jump right into things right away. And I think, again, for context, Ag Resource, no brokerage affiliations. We don't trade. All we do is get markets right as best we can, help farmers navigate the ag marketplace, politically agnostic. So with that said, been around for 35 years. We're the idea we've got, kind of our mantra, is to be prepared. I think that there really aren't any secrets here. I think in the world of grains, it's just, to be real bullish of those markets, you need a weather problem somewhere at some point, or China's got to sign a trade deal with the US. And that is unknowable, seems to be complicated. So if we stick to fundamentals, we just need supply dislocation to occur somewhere. Sort of selfishly, ideally would be South America, and we'll kind of touch on the likelihood of that happening. But otherwise, we're producing lots of stuff. That's kind of offsetting what we see in the dairy markets even. Record consumption. It is, no doubt we are using and making lots of dairy products to disappear. That is not part of this. It's just that production, not only in the US, but across the world, offsetting this. So the market's having to do more clearly, as we've seen, to clear excess inventories. So we want to start this by, communicating. We're always concerned about, Q1 or that April to May period. And part of that is just it's the winter. You're not seeing restaurant traffic as robust as you are in summer and fall. On a per day basis, we don't use as much dairy products. You're still producing quite a bit. So just that imbalance every year tends to give us pretty weak markets. Thinking back 2 years ago, we were kind of still in the middle of this bullish dairy trend, yet we saw a class 3 with a 15 in front of it for a brief amount of time. And so the question that we've got when thinking about the next 4 or 6 months is that avoidable this year, just given the amount of cows we've added to the national dairy herd, and given the seasonal increase in Oceania milk production's imminent. We don't see to date, at least, any production issues in Western Europe or Australia or New Zealand. So it just seems like there's going to be ample milk. So the market doesn't have to do as much work to encourage production, slow demand. It's kind of the opposite of those things occurring. So still a wash in supplies. And I think the big change in the dairy space the last 30 days, especially, but which is still ongoing, is finally, after 3 full years, the fat market has solved a lot of its ongoing long-term supply issues. So we will touch again, similar to what we did 2 weeks ago, in just thinking about, I think it seems like there's evidence to support this. The end user community, the processors have sorted out what they need for the holiday baking season, when we use more butter than we use in any other time of year by a large margin. So with that said, I think if they've sorted that out, what's the value of these additional pounds being produced, at least for the short term? And the market's telling us those pounds of fat aren't as valuable as they were 90 days ago, a year ago, 2 years ago. So that's what's plaguing the market. So we probably have until you get through the seasonally weak price period, March, April of next year, before we can revisit all the stuff and see if we do have to ration supplies or encourage production. But between now and then, I think we're concerned. So we like forward contracting. We like locking in feed margins. all that kind of stuff, just to be prepared for potential downside risk in the market. So that's kind of the grim outlook, but we want to be prepared for it and acknowledging that that is the case. Ignoring it is probably worse. And so even today is kind of an example. We had a pretty decent, I don't know, 20-hour jump in class 3, December class 3 specifically. But you see these charts, and we are not chartists, and I think only chart patterns work intermittently. But when you have these big, pretty clear lines, it's our idea that you want to do something. You either turn bullish, you stay bearish, just kind of inflection point. So I just wanted to highlight the red and blue lines here. Today, December class 3 milk couldn't quite make it above that initial downtrend line, and we're turning lower in the market at midday. So I think there's ingredients for bounces. The market 2 days ago, deeply, deeply oversold. It always gets reconciled, but we do think it makes sense to make some moves in the markets on recoveries. Just position yourself to kind of catch that $17.5 class 3 market and manage that through spring, maybe early summer 2026. Butter market's down to $1.80 per pound, despite all-time record exports. And I think that market's just telling us, again, we're clearing inventories, we're not having to ration supplies. And that has been the big picture issue in the dairy markets the last couple of months. The reason why butter, I think, is so weak, and again, not a whole lot has changed when you think about quarterly or annual supply and demand. It is not all that loose. Global fat and butter supplies probably end of 2025 will be a multi-year low, but we just don't need it at the moment. So I believe we highlighted this 2 weeks ago, but you see the spike in the volume of sales that happened really in the first half of summer. I think that was the end user getting covered for, seasonally very strong demand from September to the end of November. But it happened about 90 days earlier than it has happened the last 3 years, but it's come and gone. And so you see the volume of sales since then has been pretty pathetic. It's 2 million pounds per week. So again, I think it's kind of giving us the evidence to suggest, the butter market solved what it needs to for now. We will revisit this again April, May, but I think between now and then, the fat market's just kind of lost some of its story. $2.80 butter or thereabouts in the summer months did accomplish the goals that it needed to accomplish. So you're seeing class 4 not contributing as much to cash milk prices, things like that. And our mantra of being prepared, again, we don't think a lot of this changes for the next several months. So again, we want to make moves as we see recoveries in markets, whether it's class 3 or class 4, maybe even starting to think about locking in feed costs. As I'll touch in too much detail, but maybe corn, maybe soybean meal, maybe those markets are stuck for a long time. So it's the difference between, just for simplicity's sake, class 3 corn and class 3 milk and or March Chicago corn, that might get narrower over the next 6 months. So just think about that, go through your P&Ls, and I think it's time to at least engage with that forward thinking. Otherwise, again, not a lot of secret, not much behind the curtains here. We're just adding a lot of cows. We have returned per cow output growth to places like California, the spine of the central U.S., bird flu, which was a big issue a year ago, totally resolved. And so we've allowed to, given margins are not bad, a lot of places are going for maximum yield, maximum herd sizes. And so I wanted to highlight just the extent of this year's production gain. And then we do agree with the USDA, just looking at monthly numbers, probable monthly production numbers for milk for the rest of the calendar year. And they're about correct. And we've really seen them raise their annual production number almost every month for the last 5 months. Maybe they do another 100 or 200 million pounds in October or November even. So there's a lot of milk available. In their September report last week, 230 billion pounds forecast to be produced in 2025. It's up 800 million pounds from August, and now it's up 1.8% from last year, which is at the upper end of history, or the very least we can say that the milk market's kind of normalized. This, post-COVID chaos, inflation, having to ration available milk supplies that has been ended by high prices. And we've said it the last several meetings, but thinking about cash milk pretty consistently for a number of years, $22 a hundredweight or better does provide incentives, and it does accomplish different things. And I think that's just the result of what's happened when you see $22, $24, $26 cash milk. You can expect a response from the producer and the end user. this is all very normal cycle of agriculture. We just think that maybe we're going through 12, 18-month cycle where milk's not as valuable. Now, I'd say again, demand very, very good. There are ingredients for kind of periodic or intermittent recoveries in the markets, like we've seen the last 20 hours or so. So be ready for those. Take action when those happen. The export market's still very, very healthy. We are going to have multi-year high share of world dairy trade in the U.S., and that probably, I think, continues into 2026. China came back, I think, in abundance in the month of June. They probably can't, unlike soybeans, source their protein needs from many other places outside the U.S. So I think they are forced to contend to buy U.S. products despite political chaos and that souring of relations between the U.S. and China. But official exports, physical exports of dairy products, all products traded in the month of July, 248,000 tons. That is a record for the month, up 22,000 from last year. There hasn't been a real seasonal decline in the pace of U.S. dairy exports. So we're still seeing it. China's back. Mexico is growing. Latin America, the Middle East. We are very well positioned to keep this intact, this share of world trade. I think indefinitely. The question, though, is it enough? Can we use enough of the stuff to prevent sort of the producing above quotas in certain states, at least in Q1 2026? And that is the concern that we've got in the market. But cheese exports, very, very good. This is contributing pretty sizably to monthly disappearance. We have not seen any, what is pretty normal, seasonal correction. People shifting to Europe or the Southern Hemisphere. That was not possible this year. The U.S. in July shipped 52,000 tons of cheese, also all-time record for the month, of 12,000 tons from last year. And that's explained by very high prices in Europe, which are still the case today, and still very high prices in New Zealand. There is no other exporting market you can go to find reasonably priced products. So again, our kind of mantra is always trade wars or not, importers buy mostly on price. And you're saving lots of money by buying U.S. cheese, U.S. butter, a lot of U.S. dairy products. So I think this is a bright spot in the dairy space moving forward. And so thinking about that, there's going to be value as the market breaks. Again, to be very clear, Q1 is what we're concerned about, but maybe thereafter, I know maybe we're oversupplied in the milk markets, but the end user, the importer, is going to find value because they can make decent margins by importing U.S. products. Domestically, that's also the case. Butter wanted to highlight that we're still, yes.
One quick question, going back to, I guess, just in the broad scope of the dairy space, in the export conversation, is that sustainable?
I think it is sustainable.
Overly confident we can do it, but is on the buyer or the purchasing side, is it going to be sustainable? Or as you're talking about our other zones, our other competitors, are they going to kind of wake up as they're coming into some of their seasons?
Yeah, I don't think that over the course of 6 or 12 months that Europe and New Zealand, they're our principal competitors, can grow milk production enough. And we'll kind of touch on that. They are growing. Sure. But if you think about, God willing, we're going to see 2% gains in dairy consumption globally for the next decade. And you kind of start to do that math. It's got to come from somewhere. And probably, I don't think it comes from Oceania or Europe. So that's probably our hole to fill, I think. Now, it will fluctuate maybe a little more second half of 2026. But overall, I think we're going to be a larger and larger supplier to the importing community.
So it won't be necessarily unheard of if this trend, the export trend, could continue.
Yes, yeah, and I think that is almost our default position.
Okay.
Even the world markets are starting to move lower, some of them, but the discount in the U.S. is still pretty incredible. And we do think milk markets do break 2020 Q1 2026, but then that means the discrepancy between the world market and the U.S. market is going to get wider than it is today. So we're going to find export demand, I think, pretty considerably. I also want to touch on this, the Latin American market, Mexico, of course, one of them, but kind of the rest of the Caribbean, Central America, pretty decent growth, and proximity to that market is going to help.
Absolutely. Okay, thank you.
So also what jumped out to us in the trade data, census trade data for the month of July, was one, all-time record net butter exports. And so it's been nice to see this unfold as we've talked on the Dairy Signal over and over again about how cheap U.S. butter is, how the world market until the last 30 days or so, continuing to go up, the US market steady, these incredibly wide discrepancies between the US cash butter market and butter markets elsewhere. And that's translated, it was very quick this year, to incredible exports. I just wanted to show you on the right, it's kind of a silly looking chart, but we have been exporting butter to Europe. And in the month of July, we exported butter, 4,300 tons to Europe. Europe generally is a pretty decently sized net exporter of butter themselves. So we were shipping butter to the Netherlands in July. So that just highlights, I think, one, why the butter market was at 280 during the summer. And also the problems that until recently Europe has had in producing dairy products, having surpluses of butter. They didn't. They bought US origin butter. So that explains, I think, that these relationships still work. So as long as every 2 weeks, I mean, we'll show you this, of course, if US butter is cheap, I think you can expect the next bar on this graphic to be very sizably positive. So this, again, we're finding some measure or some outlet for these larger production totals. Is it enough? Probably not, but this is helpful. This is not hurtful. So that explains through, July 31st. If we look at the current snapshot, it's very similar. Indian butter has been very weak because the domestic market, our theory is that it's been satisfied. So that all makes sense. But still, there is a $1.20, $1.30 per pound discount when you compare the US to Western Europe. Maybe the Netherlands, parts of Western Europe, continue to buy US butter through the rest of calendar year 2025. Cheddar prices in New Zealand last week quoted at $2.15 per pound. That was up 7 cents from the previous week. So the US market's doing very little on a spot basis. So we're still pretty well positioned to, I think, find record exports, at least to the end of the calendar year, probably into the first part of 2026. Then it may fluctuate a bit more, but again, I don't think that on a lasting basis, it's going to be Oceania or Europe that fills this hole, this widening hole that develops over the next decade, and even the butter market. So it's been trending down, in Europe and in New Zealand. So we acknowledge that is not helpful to the butter price cause at the Board of Trade for us. But there's still a lot of work to do to drop New Zealand butter prices to $1.75 per pound. That's going to take half a year to 12 months. So we're still well positioned in the global space, but this is, I think, what explains why the markets have not really cared as we get into September, October. I think very high level philosophically, and the red bars on this are the annual change in fat-based milk exports. The blue bar is the annual change in outright milk production. So this year, we've got incredible growth in fat-based milk exports, 3.8 billion pounds. Production, though, is up 4.1 billion pounds, and maybe this turns into 4.2 or 4.3 billion. So very simply put, the surge in cow numbers, the return of per cow growth, offsetting what we're seeing in the export market. And it's different. So we look at the last couple of years. So 2024, a very good year for milk prices, the second half of the year especially. We had growth in fat-based exports of 1.3 billion pounds and contraction in milk production. That's a bull market. This is different. This is not, complete oversupply. We're not heading $14 class 3 milk, but what's different is that both the blue and red bars in this graphic are higher together in 2025. So that explains, I think, why we're seeing the dairy space do what it's doing now. It's just, again, very simple. We're producing lots of milk. There's no need to ration the supplies that we are producing. We talked about this already, 2 weeks ago, but just wanted to highlight again that it's not just the U.S. We are concerned. I mean, most of our dairy work is based on the U.S. balance sheet, but we pay almost an equal amount of attention to the foreign markets. New Zealand growing, Europe growing. Ultimately, there will be surplus milk, cheese, butter supplies at some point, like in the U.S., probably between December, February of 25, 26. And then we'll revisit how production is going outside the US a year from now, but in the short to medium term, we just have a lot more competition than we had, or rather, domestic markets in Europe, a very large market will have access to supplies. That Asian market probably has access to a few more tons of butter, cheese out of New Zealand. So things are changing globally. We also think that this explains some of the weakness because the European production to date, official production through the end of July, it's up about 400 million pounds year over year. the USDA in their forecasts, which are only updated twice a year, they project European milk output to decline in 2025. So that's different. That's been a change in the marketplace. So I do think it's important to check in on this once a month. How are they doing? It's been kind of nonstop growth the last 6 or 8 months. So just a lot of milk in the world, and that's, I think, the simplest way to explain weakness, in class 3 milk. To a lesser degree, this is just something that we've noticed because of the intensity of milk production recovery in Argentina. The last 4 or 5 months, you've seen growth of 9 to 15 or 16% year over year, recovering from some very weak levels, but it does look like, similar to Europe, the USDA, when they revisit their numbers, I think in December, so too late, but they'll have to revise upward Argentine milk production and exports. They're a small exporter, but they do ship maybe 250, 270 million pounds of cheese to neighboring markets, and that probably will be the most they've ever done. So you're kind of starting to change world trade flows just a little bit. I don't think that South America is going to be a very large importer of US. Does some of this Argentine cheese make its way into Central America, the Caribbean? Between now and the end of 2026, if they can continue growth, Argentina will help alleviate some of the tightness we've seen in the global dairy balance sheets over the last 3 or 4 years. So just again, communicating, it's a lot of places producing lots more milk. It's not just the US. So the seasonal trends, which continue to work, we think getting these precise can be challenging and maybe foolish, but the general shape of the evolution of dairy markets year in, year out is very, very similar. All of this stuff, corn, soybean meal, soybeans, dairy futures at the Board of Trade, still rooted in physical supply. So it's, starting at the highest level. The weakest price of corn is August, September, October. We have the most of it. The highest price, April, May, kind of the last gasp before you get into the new crop growing season. And the similar trends available in dairy. So like I mentioned before, we just don't tend to consume as much dairy during the winter. We're still producing adequate amounts. The market every year, Q1, pretty weak. I think it makes sense, just to start with a marketing pattern, just sell ahead, contract forward hedge Jan to April production by the end of October. I think that makes money almost every year. And that's what we're concerned about, is just these normal seasonal trends stay in place. So butter peaked early, but generally thinking about the evolution of the black, blue, and red lines here, looks like it does almost every year. So it's hard to be very bullish after you get to the beginning of the holiday season, and then we just have ample supplies of dairy products through the end of spring. So that's the risk that we want to manage. Now, if we turn to feed markets, it's been a little more chaotic than it has been. We have got some life in the soybean and corn markets, wheat markets stabilizing. Hyper focus. If you get on any ag media, social media, it is all people bickering or fighting about reported yields and yield estimates in the US, which is fine. That is totally normal, maybe healthy, just par for the course for the grain markets in the early part of autumn. I guess at AgResource, we're just unconvinced that there will be a final corn yield or soybean yield low enough to really change this pattern of adequate to maybe oversupply for the next 6 months, 12 months. Like I mentioned at the beginning of this, probably, given that geopolitics is unknowable, until we get the next big weather threat, and there will be weather threats, we're kind of stuck here. And whether that continues into the end of 2026, we don't know, but we do have to have a problem somewhere to change this. Maybe December corn's bottomed, November soybeans, maybe it's bottomed. We're less concerned with that, which just thinking rallies like we have seen are going to be challenged. We'll talk about the details of corn acres, or a lot of them, and also kind of the evolution of South American weather so far. So we don't see a lot of supply disruption. So just thinking about corn market and your corn needs, whether it's 16 billion bushels or 17 billion bushels, that's coming at the US marketplace in the next 45 or 60 days. It's the most we've had. And actually, that number exceeds production this year. The production number for corn exceeds total supplies a year ago. So again, we can debate what's upside, what's downside, but there's going to be a lot of feed products available, especially during autumn. Biofuel is a bright spot. That's what we would target to change the landscape of the U.S. ag market. I think we're seeing something happen in Brazil where they are creating these incredibly large outlets for all-time record production. But ethanol production is going ballistic in Brazil. Ethanol prices are up in Brazil. They're raising blend mandates, and so that stuff is really helpful. So E15 would be, I think, the thing we want to focus on to provide an outlet for our domestic corn. And today margins are good, whether it's renewable diesel, soybean crush, ethanol. The issue we've got is we've still got to get rid of quite a bit of the stuff in the export market. That might be a little more difficult. We also think about, again, we can't disprove that U.S. corn yield by the final count will be 180 or 181, not 188. But even if that's the case, rallies in the market, does that work to slow demand? Does that incentivize South America, who starts planting in earnest over the next 60 days? Does it really solve any problems, permanently? And that's just going to be tough. I think we're in a period like we were between 2015, 2019, just waiting on the next spark. So far, probably famous last words, I know, but we're seeing a pretty normal development of Brazil's rainy season. Drought has ended in Argentina. So if every day we wake up, what is the next supply threat in the grain markets? At least for the next month, it's not going to be South America. So again, most likely corn stuck. It's just hard to be overly bullish or bearish. We're both fighting for leverage every day. And it's been frustrating to watch the corn market, especially soybeans as well, when you're touching these major moving averages, these inflection points. You think we're making the next move, only for the market to do exactly the opposite, even cents per bushel the next day. And so I think we're kind of already there at the point where we know we've got, maybe it's not oversupply of corn, but adequate supplies. Neither side's really rushing to get much done, and we're kind of volatility has left the space. And that is something that happens when you've got adequately supplied grain markets. And whether you're bullish or bearish, that we debate that every 2 hours. But the reality is that you just don't have a lot of volatility, and you're just kind of stuck with pretty narrow weekly, daily, monthly ranges. This, I think, we're going to jump into the weeds now. What catalyzed, I think, corn's recovery, maybe to a lesser extent soybeans, is, lots of crop tours, including our own, including Pro Farmers, private tours, which are still ongoing, expected just an incredible amount of plant and ears per acre to be found. NASS is the final arbiter of this. They budget, capacity to look at crops higher than anyone else's by, a billion-fold. And so the objective yield data during the autumn months is what we focus on. And the September report's the first that includes any of this. We'll all debate ear weights, pod weights. We'll leave that to NASS in October and November. But what they do give us is plant population data. And so it's kind of a shock to see that, ears per acre, weighted average in the 10 highest producing states, just 28,700. That matches last year's final number and is down 200 from their September estimate a year ago. So what you are looking at here is the blue bars are ear counts, the red dots are yields. So the difference between the blue bars and the red, similar to last year, pretty wide. So that is the burden on ear weights. And that's why I think you can go in and say it's been incredibly dry in the eastern Midwest, places like Tennessee and Kentucky. We've got this unknown disease issue with southern rust expanding into the Midwest more than it has in recent years. And what that means for yields on a field-by-field basis is very hard to quantify. So I think we had this bullish reaction to the September WASDE because you saw this ear count number and said, let's say, for example, my yield estimate of 177 is not unreasonable. It's left to combine data to tell us what it actually is, but I think he opened the floodgates to any possible corn yield, and that's why we've seen premium added to the market. The WASDE itself, though, to us wasn't terribly impressive, and wanted to highlight a couple of things. Is one, yield is down, just about 2 bushels per acre, which makes sense given what the USDA knows, vegetation health, crop ratings, what small amount of corn ears they could pull, mechanically dry down, estimate ear weights on at least those. I also wanted to highlight, though, so we're, the default, something like 2 billion bushel in stocks. This year, unlike last year, I think they've got a lot of demand built in, or at least all-time record exports, all-time record domestic use. And so I think the market does need every single bushel of this to validate the USDA's forecast. So we'll kind of go through scenarios. again, I can't disprove that final yield will be 182 or something. What does that mean? How does the rest of this fall into place? So the WASDE itself, I'd say it's kind of boring, but it was the year accounts that lifted the market and provided some more uncertainty, which makes sense. I mean, here is current drought monitor. You've got severe drought, pretty widespread across the eastern Midwest and Mid-South. On the right, you're looking at rainfall as a percent of normal since August 1st. And for all intents and purposes, a lot of Missouri, Illinois, Ohio, zero rain. And we can all, we live here, we see and feel this. The grass is brown. Things aren't doing very well. What does this mean for yield? Certainly doesn't help it. I think if you would have had an adequately wet August, corn yield of 190 would have made sense, but it didn't happen. Here we are. We've got another growing season where we did have a hiccup in a large enough portion of the corn belt that you do have to trim your yields. Why we're kind of unconvinced that there's going to be a supply problem, though, is the periphery states, which are very large producing states, like Wisconsin, Kansas, Nebraska, parts of Kentucky and Ohio at least, probably do pretty well. So we're all concerned that we're going to lose 4 bushels an acre on corn nationally, maybe a bushel and a half of soybean yield between now. Probably doesn't happen in October, but by January, like a year ago, it's incredibly hot, incredibly dry finish to the season. Moisture levels abnormally low. The USDA couldn't account for that until their final reports. Well, I just wanted to communicate that this is the coverage of drought and the changes over the last 52 weeks. Illinois, central southern areas, Indiana, Michigan, Tennessee, Arkansas, doing a lot worse. Still a lot of green on this map. So thinking about dry land corn in places like South Dakota, Nebraska, and Kansas, not yielding 80 bushels an acre, but 180 bushels an acre. I think that goes a long way to offset some of the big time yield concerns nationally that at least the rumor mill is putting out. So again, is it convincing enough, the disease, late season dryness, to drop yield to below last year? Time will tell. We are now ending our own kind of estimation season. We're just waiting to see what the combines tell us, but just want to communicate a lot of places are doing very well weather-wise and a lot better than last year. We also don't think, and this is even more so in the weeds, we spend too much time on this. The conventional wisdom is that smaller crops from August to September continue to get smaller, but we haven't found that. So this is corn yield, and on the x-axis, you've got the change from September to August, from August to September. And then on the y-axis, you've got change from September to January. You can see there's no correlation here. So small crops don't get smaller, big crops don't get bigger. There's really no trend to be followed between September and January in terms of yield changes. They can go up, they can go down. Again, we are just waiting on combine data at this point. But also wanted to show you that in the last 5-9 years even, for better or worse, maybe because of protocol, the USDA really hasn't changed their corn yield in October at all. The average on an absolute basis since 2015 is 0.6 of 1 bushel per acre. There have been a couple of years scattered in where it's been less than 0.2 of a bushel an acre. So to see confirmation of these concerns about dryness and disease, I don't think we're going to get that in the October WASDE. Something the market pays attention to. So when do we determine that we've maybe have a supply issue? Maybe that's not until January of 2026. Corn specifically, this is less an issue for soybeans. I think the soybean market should be sensitive to yield. Should it be worse than expected? Because we didn't plant a lot of the stuff. But the big surprise in the USDA's crop production reports since the middle of summer has been acres. They have raised corn acres by, I think, over 2.5 million from July. That offsets a lot of really the entirety of this yield debate, I think. And so is there some kind of conspiracy here, or this is very unusual? We do know that in the last year, they have started to incorporate Farm Service Agency enrollment data into their monthly estimates. That is unique to the last 2 years. So we kind of dug into it. Let's put all this together. And what we found is incredibly boring. And so since we are in a bear market, we have found that if you combined all crops enrolled in FSA acreage, as of September, we are down slightly from last year. When we isolate the big 4, corn, soybeans, wheat, and cotton, and let's add prevent plant, which is only reported by FSA, add that to the list, and we're still down on last year. So I think that NASA's official U.S. acreage estimates do make a lot of sense. I don't think they're going to change this. And you dig even deeper, you just find that the US planted a lot more corn and a lot less of everything else. Cotton acres were down just under 2 million. Bean acres were down 5 or 6 million. Wheat acres were down 700,000. So if you put all that together, we're still at a loss of 355,000 acres when looking at the NASS numbers. So I think we're stuck with corn harvested area of 90 million, be the highest since 1936. So that begs the question again, when we're thinking about upside risk for the producer or what to do with feed coverage if you're a dairy operation or end user. Again, our default answer is kind of I think the corn market's just stuck. So what yield do you plug into this? If you are concerned about dryness and disease, reported yield so far, whatever it is. We are just going through scenarios here. None of this will be terribly accurate, but we think and are concerned that if we don't get all of those bushels of corn demand the USDA is projecting, and the reason for that is there's a lot of production gains in Ukraine and Brazil. Ethanol, for example, just from a very simple analysis, mostly this is going to be miles driven gasoline consumption. We have just seen that stagnate the last couple of years, so we're kind of struggling to match USDA's ethanol number for better or worse. And it's going to be tough to grow corn's inclusion as well because we've got a lot of sorghum. We've seen that really impact corn demand for ethanol negatively the last 6 months. Anyway, we're still very high in demand, just not as high as USDA. So let's go through some scenarios. If yield's 187, we're concerned that we've got 2.5 billion bushels or more of corn. It's still pretty neutral market here, but does challenge rallies pretty significantly, like we have seen. Even if we were to plug in 182, we think we're still left with just over 2 billion bushels of in stocks. This is still higher than USDA's forecast. And so even if this is 1.8 or 1.9, I don't think you have in stocks. You don't have the catalyst to get to 460, 470 March, $5 spot. So we just want to be prepared. Again, it's the market can rally. We can break through moving averages. The question that we have always had for 3 decades is what do you do with it? So again, because of the acreage work that we've done, I don't think there's going to be a shortage of corn. The market doesn't need to ration corn. The market doesn't need to incentivize Brazil, Argentina to plant any more of the stuff. And I think that the market will sort that out. So just be prepared to sell on recoveries, maybe wait on corrections to secure forward feed needs. The market is stuck. And while we're kind of watching export demand from the U.S., which has been incredible the last year, a little more closely is because we do know we've got a lot more corn in Brazil. It's being used domestically quite a bit more, but they are shipping more than they were a year ago. So last year, exports of corn out of Brazil weren't terribly robust. But so far, just counting all the ships that are in lineups at ports in Brazil, we've got exports in September at about 7.5 million tons. That's 1.5 million higher than it was a year ago. It's competition for imported demand. So that's something we just have to contend with. On the other side, and thinking about producers, it's going to be important where you sell your crops to. We do think that the domestic processing markets are going to be your best bet. This shows you the cash ethanol production margin in Western Iowa as it sits today, and it's very good. So I think ethanol plants will be able to bid up for corn. If you were in charge of an ethanol plant, why not just buy the entirety of your annual needs, lock in your annual margin, and be done with it? So on breaks, if you're near an ethanol plant, I imagine that the bid will be pretty good. I suspect ethanol plant bids will only go up seasonally as we get into spring 2026. It's a positive thing. Soybean crush margins also very, very good. So the crush, the processor is going to be your best bet over the export market in soybeans. So be mindful of all of that. We also wanted to show you and why we think we're not terribly bearish of corn relative to current prices is something is evolving in Brazil. They will have a lot of corn to export, more so than they had last year. It's an issue for the U.S. balance sheet. But like I mentioned, policy-wise, they are making sure they get rid of it in bulk in the domestic ethanol market. So record production of Brazilian corn. The market's on the left. You're seeing the cash corn price index there. This is kind of boring. It's above where it was a year ago. It's probably bottomed seasonally. And because they're absorbing so much of the supply at ethanol plants, several more plants will be built there over the next 2 years. They are expanding. So we know this. We know they're producing just incredible amounts of ethanol, but the ethanol market in Brazil also going up counter seasonally. So it seems like there is room because of blend rates to grow ethanol production in Brazil even further. So this is taking a lot of corn out of the world market that is produced in Brazil. Not all of it. They're still an incredibly large competitor of ours, but this is something that's happening in the background. Maybe the world does use a lot of corn that we produce. Maybe December corn, March corn can't really break below $4 for a lasting period of time because I think global demand, Brazilian demand is very, very high. So rather than being bullish or bearish within a range of 4 to 440 or so, we just think that the market is stuck there. And we have seen this before. Maybe we found a new plateau. Maybe that plateau is rooted in Brazil's ethanol market. But I just think the market, when we do a dairy signal 1 year from now, 2 years from now, it's going to kind of look like it did 2014 to the early part of 2020. So I think be prepared for that on both sides. If you're a bull, there's a little room to run, but maybe not much. If you're a bear, be careful as you get breaks. Again, our kind of main thesis is just we're close to a period when volatility more or less exits the market until we get the next supply threat based on weather or U.S.-Chinese deal. Who knows the timing of that or if it happens. Soybeans, we will dive into soybeans just very briefly. And this is a market that's sort of concerning to us. And we'll ask the question, take it week by week, but is there some kind of reckoning ahead of us in terms of export demand? We are at war with China economically. Both countries fighting for, I think the idea is dominance of global economic issues 2 and 3 decades from now. So both sides are going to fight. And that's what we want to communicate here is China is going to fight back. They're using soybeans purchases to some extent as leverage here. They have not bought 1 bushel of soybeans from the U.S. yet. A year ago, the U.S. exporter had sold, by the second week of the crop year, about 215 million bushels of soybeans. That is probably demand that's been lost. We can kind of see in ship movements and lineups, China's probably started to secure their soybean needs with South American soybeans into the first week of November. Soybean exports from the U.S. to China peak Sept in November. We're losing demand. And so we are concerned that there is this decoupling that happens on a lasting basis if we can't at least progress trade negotiations to some extent. So that was a long-winded way of saying, let's do the exercise for the U.S. soybean balance sheet. Let's assume 53 bushels an acre. That is down from USDA's forecast. But we have lowered exports to under 1.5 billion bushels, which is a fluid number, but I want to be honest, this does align with the pace of sales to China and the pace of sales to all others as of the middle of September. And actually, some of the pace analysis where it gets pretty alarming. So you're not left with an oversupplied soybean market, but 450 million bushels is a $9 to $10 market. If you assume a 52 bushel an acre yield, you're still left with 375 bushels an acre. Maybe that's ending stocks of 375 million. That's a market, maybe 950 to 1050, all because we've lost Chinese exports. So we want to think about this as we digest. What are concerns? Very real concerns about dryness in the eastern Midwest, Missouri, Kentucky, Tennessee. Exports are more than offsetting when we get into this debate. And so I know the market's hyper-focused on yields. Our idea at Ag Resources, though, is we are too, but we have to acknowledge that that is just one piece of the puzzle in terms of price discovery, especially given none of this is new, but the expansion of production and world market share in places like South America, Ukraine, Russia, parts of Eastern Europe. It's a very global market. U.S. yield means less than it did 15 years ago. So we want to get yield correct, but very quickly we have to move on to demand. South American weather, what is next? What does the world balance sheet look like? There was also no trend in changes in USDA's soybean yield estimates. So like corn, small crops don't necessarily get smaller and vice versa. So I think we're just kind of at the mercy of combine data, USDA's October yield, whatever that is. Expect a surprise, but just wanted to say it could be higher. There's just no evidence to suggest they've got to move one way for 4 months consecutively. Here's the issue with soybean exports. When I talk about pace analysis, so total commitments of soybeans sold out of the U.S. for new crop delivery as of last week, it's 380 million bushels. That is now below the last U.S.-Chinese trade war, about 30 million bushels. And so these correlations or these studies will get tighter over time, but for now they work okay. So you can see here that we've got on the right export commitments as of now compared to final U.S. soybean exports. The line's pretty clear, the trend. There are some pretty big discrepancies, but this does get very, very tight by about December 1st. So there is runway, but there's not a lot of runway. Today, if this correlation were to work perfectly, you would have final U.S. soybean exports of just 1.2 billion bushels. It would be 600, 700 million bushels soybean in stock. So I don't think that that's how this evolves, but I think that is concerning and becomes part of the mentality of the market once we know crop size. Losing Chinese demand is just a very, very big deal. Even in 2019-20, we were still shipping some amount of soybeans to China. Today, that number, until there's a deal signed, until we both drop tariffs on both sides, that number could be zero. Thinking about, too, if Brazil can plant their soybeans on time, they will have some tonnage of soybeans available for export in the month of January. And so that's when the window shuts. So again, thinking about if you're a producer, $11 January 27 soybeans, even spot soybeans today, there are opportunities. We just want to manage risk. And again, the mantra for this episode of The Signal is be prepared for things. And I don't think there's going to be an issue with meal production. We are seeing crush capacity of soybeans expand. We are seeing mill exports not quite offset the production gains, but we are just going to be producing lots of soybean, lots of protein meal altogether in North America for the next year. Meal production in August, and these discrepancies year over year are getting wider. So NOPA member meal production in August was 4.5 million tons, up 20% year over year. Total production through August, 7% year over year. We probably add another 3 to 5% to this in calendar year 2026. So the meal market will be sideways, probably not terribly bearish, but just keep in mind that market almost constantly is going to have to work to clear inventories. Can't really sustain rallies until there is a supply hiccup, probably in Argentina, who, again, is the world's largest exporter of soybean meal. Canadian weather has done very well as well. And that's part of the issue for the feed markets and the feed market pricing, especially, is even ignoring U.S. trade policy uncertainty. Weather has been very good in Canada for the most part. In the U.S., I know we'll debate the details of yield, but we avoided major issues until the very end of the season. Mexico, water is abundant, so just that's been different than the last 5 years or so. Canada's canola meal production last week raised to 20 million tons. They probably will produce 7 or 7.5 million tons of canola meal. That will be the highest on record. Canada's got its own issue with China. I think there's still 100% tariff from China on Canadian canola products. So a lot more of the Canadian canola products will have to find other markets, including the U.S., including domestically within Canada. So like the U.S. soybean meal market, kind of looking to clear inventories, none of that's terribly bullish. But like corn, I think the default outlook is just very sideways, neutral price pattern for soybean meal until you've got the next supply disruption. And that comes next potentially in South America. So we'd be sellers of $320 meal, buyers at $250, $260. That is the range to trade, I think, indefinitely. And South American weather, which we have talked about, that's the next thing to monitor. The growing season, I suppose, has technically started in some places, so it's very, very early. Not until maybe the second half of January can you put to bed whether we've got big yields or small yields in South America. But everything looks to be pretty normal so far. So this is the current 10-day South American rainfall forecast. I have circled the major crop areas of Brazil, Eastern Paraguay, and Argentina. It has rained a lot in Argentina so far. Drought has ended completely. We are looking at pretty sizable surpluses of soil moisture nationwide, Argentina, Paraguay, and the far southern states of Brazil. In the northern half of Brazil, where you see the top half of this circled area, that is Mato Grosso, now the largest soybean producing state on earth. Rainfall there, as I'll show you in a bit, very seasonal, rigidly seasonal, but it does look like the monsoonal pattern starts in the next 2 or 3 days. Once it starts, it doesn't really shut off. They'll probably plant soybeans 3 weeks earlier than they did last year. Last year, plagued by drought. So crop progress, crop dates look to be pretty routine in Brazil. And that's why I mentioned if this is correct, then you're harvesting soybeans in northern Brazil in January, maybe the last week of December. So markets get replenished very quickly because we're growing so much in both hemispheres. And this is just what I mean by I say, rigidly seasonal, Mato Grosso weather. Maybe not today. We're only trading the soybeans that exist on Earth today. But if we fast forward 100 days, Mato Grosso, pretty critical to global soybean meal, even corn supply and demand. They grow a lot of second crop or winter corn in Mato Grosso. So if they can plant their soybeans on time, they can plant their corn on time after they harvest soybeans. And so you're just kind of taking some supply risk out of the market. And just wanted to show you here, statewide average, if the forecast is correct, in the month of September will be about 1.5 inches. And then we're kind of off to the races until March or April. So again, today, famous last words again, don't see a glaring climate threat in South America. So like we have said over and over again, being prepared is the mantra. Managing risk as you get both upward swings and downward swings in the markets. Keep in mind, we think we're stuck in pretty neutral price ranges indefinitely. So, as always, throwing a lot out at you. If you have any questions after today, please don't hesitate to reach out. And thank you for your time.
Absolutely. Thank you, Ben, for helping break it down. Because to your point of the not enough to know the news, you need to trust the analysis. So thank you for helping us break it down and just, I'd say small pieces, but it was still a lot. It was like drinking out of a water hose, but I promise in a good way. So thank you for that. As we dived in and kind of like you and I were talking about, again, be prepared. Right now, I think what might be on a lot of people's top of mind is the idea or the topic of storage. I mean, we have great yields theoretically. We have the potential for great yield coming out, but where's it going to go? So if you want to try to sell it later in the year, you have to be able to hang on to it. So do you have any marker or anything to add to the discussion of storage?
Yeah, I think that's one of the big issues, and maybe it's a very good point. Is that a shoe to drop yet? Thinking about a 16 billion bushel corn crop, I don't think the market always has access to perfect information. So, do we get to the point where storage becomes an issue and then something happens? I mean, look very closely at carries. I know a lot of that's counted in, but if you're making pennies by selling out months, again, these carries in corn, even soybeans, are pretty large. So look at bids at the elevator, forward bids, forward futures. If we can squeeze nickels and dimes out of this, do that. And to that point, I think it's store whatever you can to get those carries if you can. So yeah, that's going to be an issue. We don't have any real advice. Storage or silo bags seem to be becoming more popular globally. Maybe let's kind of entertain storage expansion capacity the cheapest way possible. Somewhat relatedly too, look at those carries in the market. Look at what we think could be fair value in class 3 milk the month of February, 15 and a half to 16 and a half. Where is the market today? Some of this is just time risk built into the market, but if we don't think that it stays there, we got to make a move. I think for a couple of minutes, at least this week, January soybeans were $11.01, January 2027. That contract could be $9 a year from now. So those are, I think, the opportunities that we've got. And so, again, I think storage capacity expansion, if it can be done for a reasonable price, makes sense in this era. But again, I still think doing the work on not selling a harvest makes good sense.
Absolutely appreciate the insight and the thought. Thank you. We did have a question come in as well. In June, we were all surprised with sudden availability of milk. And how are we learning? And now we are learning that the fat market kind of lost its story even before the summer heat waves arrived. Can the pendulum swing back as fast as it swung forward, or are those market swings not subject to the same pacing?
Yeah, it's a very good question. I think the pendulum could swing. I guess what we are learning, and some of this is anecdotal or small sample sizes, is you guess you probably have to get to break even or get below the price of break even at the largest dairy operations. We don't know exactly what that is, but then I think thinking about this 200,000 head herd sizes in places like Texas, very big herds, across the Central Plains. I don't know what that break even is, but I think if you drop below that, yeah, the pendulum starts to swing pretty quick. I guess our fear for them and the rest of the market is, do you get to something close to that during peak imbalance of supply and demand during the winter? So I think so. I think it's going to be price that does it, and I don't know how low the market will have to go for even a brief period of time before that happens.
Okay. Appreciate it. Before we head out today or we part ways, I mean, there was a lot of key takeaways, a lot of things to, hunker down on or consider, forward thinking. Other than the mantra of be prepared, what would be another key takeaway you want us to walk with to the rest of the week?
Yeah, speaking mostly to the dairy operations. Yeah, I don't know what anyone's balance sheet looks like, but I think it's most of what we do is not getting things exactly correct. But if margin is fine, lock it in. I think some of the things that we're concerned about, just if you can pass this risk off onto someone else, maybe milk prices go up $1 or 100 weight. But if we can lock in profitability at any point in the next 30 days, lower corn, higher milk, I think that we want to start with that because there's a lot of unknowables. A lot of trade policy, politics, of course, always going to have an outsized impact. How all this evolves, the economy also fine, but showing some holes. Thinking about a lot of other emerging market economies, those are not doing so great. So I think there's just a lot of unknowns. If we can lock in some measure of profitability today or a week from now, I think you start doing something.
All right. Appreciate it. Again, thank you. Thank you for your time, your insights, and the deep dive that you were able to take with us. Appreciate you joining us basically every other week. So between you and your team, again, thank you to you guys. Thank you to our listeners for tuning into another episode of the Dairy Signal. I will give a shout out. There's a lot of topics, not only here on the Dairy Signal, but also conversation and programs coming down the pike from PDPW. I encourage you to check out our website at pdpw.org and check on our calendar, what's coming down, what's coming in the month of October, November, and further into the year. If there's topics, regardless if it's on the Dairy Signal or other programs you'd like to see us execute, please do not hesitate to reach out. We appreciate all of your insight and comments throughout the year. It's very welcomed and very much appreciated. And before we part ways, one more shout out and a special thank you to our partners that make the Dairy Signal and our programming possible throughout the year. So thank you to our national sponsors and our partners for making this possible. Without further ado, have a great day and a great rest of your week, everybody. Thank you.